How wealthy retirees protect against long-term care costs. If you're over 60, here's a number that should stop you in your tracks. The average American couple will face over $300,000 in long-term care costs during retirement, and Medicare covers almost none of it. Let me repeat that. Most of this devastating expense comes straight out of your pocket, threatening everything you've worked so hard to build. In my 3 decades of guiding affluent retirees, I've seen even the best-laid plans unraveled by a single health event. The wealthiest retirees I work with all share one secret. They never leave long-term care to chance. Every year you wait to address this critical risk, your options shrink and the costs climb. I've helped thousands of seniors safeguard their savings and ensure their families aren't burdened by unexpected care expenses. This is educational content designed to help you make informed financial decisions. Always consult with a qualified advisor for your unique situation. And remember, past performance doesn't guarantee future results. Today, I'm going to reveal the strategies top retirees use to protect their nest eggs and maintain control, even when facing rising healthcare costs. By the end of this video, you'll know exactly how to shield your assets and secure your legacy. But first, let me share the most overlooked mistake that could cost your family everything. Pay close attention, because what you're about to learn could change your retirement forever. Part 1. The hidden threat to your retirement security. Let's start with an honest, direct question. Have you ever truly calculated what a serious long-term care event could mean for your retirement savings? If you're like most Americans over 60, you've spent decades working hard, saving diligently, and planning for a comfortable, secure retirement. Maybe you've built up a healthy 401k, a sizable IRA, and perhaps even a well-managed brokerage account. You've paid off your mortgage or are close to it. You might even be helping your grandchildren with their education. On paper, you're in a strong position. But here's the reality that too many retirees overlook. One that, in my 30-plus years of advising affluent seniors, I've seen derail even the most carefully crafted plans. Let's talk numbers, because numbers don't lie. According to the U.S. Department of Health and Human Services, nearly 70% of Americans turning 65 today will need some form of long-term care in their lifetime. That's 7 out of every 10 people. The average cost of a private room in a nursing home now exceeds $108,000 per year. Assisted living facilities run between $54,000 and $65,000 annually. And even home health aides, just a few hours a day, can cost upwards of $60,000 a year. Let me repeat that. If you or your spouse require 3 years of nursing home care, you could be looking at a bill of over $324,000. And that's in today's dollars. Healthcare costs have historically risen faster than inflation, meaning these numbers could be even higher when you need care. Now you might be thinking, I have Medicare. Won't that cover me? Unfortunately, this is one of the biggest misconceptions I see among retirees, even those with substantial assets. Medicare only pays for a very limited amount of skilled nursing care, typically up to 100 days and only under specific conditions after a hospital stay. After that, you're on your own. Medicaid, on the other hand, is designed for those with very limited assets, usually less than $2,000 in most states. So if you've saved diligently and built a comfortable nest egg, you're essentially caught in the middle. You earn too much to qualify for assistance, but not enough to cover years of care without seriously depleting your assets. Let's put this into perspective. Imagine you and your spouse have saved $1 million for retirement, a figure many would consider a sign of financial success. Now, subtract $324,000 for 3 years of care for just one of you. If both of you need care, as often happens, you could see over $600,000 evaporate in just a few years. That's money you intended to use for travel, hobbies, or to leave a legacy for your children and grandchildren. I've seen clients forced to sell their family homes, cash out investments at the wrong time, and even raid their grandchildren's college funds, all because they didn't prepare for this very real risk. And the risk isn't just about money. The emotional toll on families can be staggering. I've worked with countless retirees whose children had to quit their jobs or move across the country to provide care. Relationships are strained, and the stress can be overwhelming. Many retirees assume their spouse will be able to care for them, but statistics show that caregivers, often spouses in their late 60s or 70s, are themselves at high risk for physical and emotional burnout. Let me share a story with names changed for privacy that illustrates just how quickly things can change. A few years ago, I worked with a couple, let's call them John and Mary. They'd done everything right, maxed out their retirement accounts, paid off their home, and even set aside a generous college fund for their grandkids. But when Mary suffered a stroke at age 72 and required full-time care, their expenses skyrocketed overnight. Within 2 years, they'd spent over $200,000 on care not covered by insurance. John was forced to liquidate investments during a market downturn, locking in losses that could have been avoided. Their financial security and their peace of mind was shaken to the core. Now I know these are difficult realities to confront. It's tempting to believe that it won't happen to me, or that you'll be one of the lucky few who never need care. But remember, nearly 70% of retirees will face this challenge. And the wealthier you are, the more you have at risk. I've seen families with $2 million, $3 million, even $5 million in assets struggle when faced with years of escalating care costs, especially if they haven't planned ahead. Here's another sobering statistic. According to Genworth's 2023 Cost of Care survey, the cost of long-term care has increased by an average of 4.5% per year over the past decade. If that trend continues, today's $108,000 nursing home bill could exceed $160,000 per year in just 10 years. That means waiting even a few years to address this risk could cost you tens of thousands, if not hundreds of thousands, of dollars more. And there's another layer to this challenge that too many people miss: the threat of financial scams and elder fraud. Seniors facing health crises are often targeted by unscrupulous individuals offering miracle solutions or fake insurance products. In my years of working with retirees, I've seen heartbreaking cases where families lost their life savings to scams disguised as long-term care solutions. This is why it's so important to work with experienced, credentialed professionals and to approach any too-good-to-be-true offer with extreme caution. So, let's recap what we've covered so far. The risk of needing long-term care is high, nearly 70% for those over 65. The costs are staggering, with the potential to drain hundreds of thousands from even the most robust retirement portfolios. Medicare provides almost no help, and Medicaid is not an option for those with substantial assets. The financial and emotional toll can be devastating, not just for you, but for your loved ones. And the longer you wait to address this risk, the more expensive and limited your options become. Now, here's what most financial advisors won't tell you. There are proven conservative strategies that wealthy retirees use to protect their savings and maintain control. Strategies that go far beyond simply buying a standard insurance policy or hoping for the best. In my 30-plus years of helping retirees, I've seen firsthand how these approaches can mean the difference between a secure, dignified retirement and one filled with worry and sacrifice. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any decisions. Remember, no strategy can guarantee specific results, but understanding your options is the first step to protecting your legacy. But the solution is simpler than you think, and most people get it wrong. In the next section, I'll reveal the core strategy that affluent retirees use to shield their assets from the rising threat of long-term care costs, and why this approach works especially well for those with substantial retirement savings. Stay with me, because what you're about to learn could transform your financial security for years to come. Part 2. The Core Solution Foundation: how affluent retirees shield their nest eggs from long-term care costs. Now that you understand the magnitude of the long-term care threat, let's shift our focus to the solution. In my 30-plus years of guiding retirees just like you, hardworking Americans who have built up substantial nest eggs, I've seen that the most successful and financially secure seniors don't leave long-term care to chance. They use a blend of conservative, proven strategies that are designed to protect both their savings and their peace of mind. Let's get right to the heart of it. The core solution that affluent retirees use isn't just about buying any old long-term care insurance policy. In fact, traditional policies have become increasingly expensive and, in some cases, unreliable, with premiums that can spike unexpectedly and benefits that may not keep pace with rising costs. Instead, the wealthiest and most cautious retirees are turning to a combination of asset-based long-term care solutions, customized insurance hybrids, and integrated estate planning. This approach is designed to fit the unique needs and risk profiles of those who have worked hard to accumulate significant assets and want to ensure they stay protected, no matter what the future holds. Let me explain why this strategy works so well for seniors with substantial savings. First, asset-based long-term care solutions, sometimes called hybrid policies, allow you to reposition a portion of your existing assets, such as cash, CDs, or even a portion of your IRA or 401k, into a vehicle that provides both long-term care protection and a death benefit. If you never need long-term care, your heirs receive a tax-advantaged legacy. If you do need care, you can access the funds, often tax-free, to pay for qualified expenses. This means your money is never wasted on premiums you might never use, which is a common concern among retirees. And because these policies are funded up front or over a fixed period, you avoid the risk of future premium increases that can catch so many seniors off guard. Let me share a real-world example, one that's played out in my practice many times over the past decades. I once worked with a couple, we'll call them Frank and Linda, who had accumulated just over $1.5 million in retirement savings. They were in their early 70s, healthy, and wanted to make sure their children would inherit the family home and a significant portion of their investments. Frank was especially concerned about the risk of dementia, which had affected his father and required years of expensive care. After reviewing their options, we repositioned $200,000 from a low-yielding money market account into a hybrid long-term care policy. This provided each of them with over $350,000 in long-term care benefits, more than enough to cover several years of high-quality care at today's rates. If neither needed care, their children would receive a tax-free death benefit of $220,000. For Frank and Linda, this solution offered peace of mind. They knew they were protected, their legacy was intact, and they wouldn't be forced to sell investments or property if the unexpected happened. This approach is especially powerful for affluent retirees for a few key reasons. First, you likely have assets that aren't generating significant returns, such as cash, CDs, or even a portion of your bond portfolio. By repositioning a portion of these funds into a hybrid policy, you're not only protecting against the risk of long-term care, but also potentially improving your overall financial efficiency. Second, these solutions often come with guaranteed benefits, meaning you know exactly what you're getting, with no surprises down the road. And third, for those who are concerned about qualifying for traditional long-term care insurance due to health issues, many asset-based solutions have more flexible underwriting, making them accessible even if you've had some health challenges. I've seen this strategy work time and time again. Take the case of Margaret, a widowed retiree in her late 60s with about $2 million in total assets. Margaret was concerned about protecting her independence and not becoming a burden on her children. She'd heard horror stories from friends about rising care costs, but she was hesitant to purchase traditional long-term care insurance after seeing her sister's premiums double over a 5-year period. We looked at her portfolio and identified $150,000 in a conservative bond fund that was earning less than 2% annually. By reallocating those funds into a single premium hybrid policy, Margaret secured over $400,000 in long-term care benefits with a built-in death benefit if she never needed care. She told me, "For the first time, I feel like my future is truly protected, no matter what happens." Now you might be wondering, isn't it risky to move that much money into an insurance policy? That's a great question, and one I hear often. The key here is that asset-based policies are backed by some of the strongest, most stable insurance companies in the country, many with 100-plus-year track records and billions in reserves. These are companies that have weathered world wars, recessions, and financial crises. And because you're not spending your money, you're repositioning it, you maintain control and flexibility. If your needs change, many policies allow for partial withdrawals or even full surrender, with some or all of your premium returned depending on the timing and terms. Let me pause for a moment and emphasize something important. This is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before making any decisions. No strategy can guarantee specific results, and it's critical to review the details, costs, and benefits with a professional who understands your full financial picture. So, why does this approach work so well for seniors with substantial retirement savings? First, you have the assets to make a meaningful impact. Repositioning $100,000 to $300,000 can create a significant safety net without jeopardizing your lifestyle. Second, you're likely in a position where protecting your legacy is just as important as protecting your income. Asset-based solutions allow you to do both, shielding your nest egg from the devastating costs of long-term care while ensuring your loved ones are taken care of if you never need care. And third, you value certainty and control. With guaranteed benefits, no future premium surprises, and the flexibility to access your funds if needed, you gain the security and confidence that every retiree deserves. Now you may have heard conflicting advice about long-term care planning. Some advisors push traditional insurance, others suggest self-insuring, and still others recommend trusts or gifting strategies. The truth is, there is no one-size-fits-all answer. But in my decades of experience, the wealthiest and most successful retirees almost always use a combination of strategies, including asset-based long-term care, tax-efficient withdrawal planning, and integrated estate planning to build a robust, flexible, and resilient safety net. Before we move on, let's recap. The core solution for protecting against long-term care costs isn't about taking unnecessary risks or buying the cheapest policy on the market. It's about using your existing assets strategically, leveraging hybrid insurance solutions that provide both care benefits and legacy protection, backed by financially stable companies. It's about gaining control, certainty, and peace of mind, so you can enjoy your retirement without the constant worry of what if. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation, and remember that no strategy can guarantee results. But by understanding the options available, you put yourself in the driver's seat, ready to protect what you've worked so hard to build. Now, let me show you exactly how to implement this in your own financial plan, step by step. The process is more straightforward than you might think, but there are a few critical details you need to get right to ensure your strategy is effective and efficient. And before you take action, you need to avoid these critical mistakes that have cost retirees tens of thousands of dollars. Stay with me, because what you learn next could make all the difference for your retirement security. Part 3: Practical Implementation Steps. How to secure your long-term care protection. Now that you understand the core strategy that affluent retirees use to shield their nest eggs from long-term care costs, let's get specific about how you can put this into action. I want you to feel empowered, not overwhelmed, as you take the first steps toward protecting your savings and your family's future. In my 30-plus years of working with retirees across the country, I've found that the most successful plans always start with a clear step-by-step process, one that addresses your unique needs, leverages your existing assets, and leaves no stone unturned. Remember, this is educational content, not personalized financial advice. Every situation is different, and you should always consult with a qualified financial advisor for your specific circumstances. My goal here is to give you a practical roadmap built on proven strategies and decades of real-world experience, so you can confidently move forward. Let's walk through the process together, step by step. The first and most crucial step is to conduct a comprehensive long-term care risk assessment. This means sitting down and taking a clear-eyed look at your current health, your family's medical history, and your financial situation. Ask yourself, how likely is it that you or your spouse will need care, and for how long? Consider that, historically, women require care for an average of 3.7 years, while men need about 2.2 years. If you want a conservative estimate, plan for at least 3 years of care for each spouse. Multiply the average annual nursing home cost, currently about $108,000, by 3 years, and you're looking at $324,000 per person, or $648,000 for a couple. This is the amount you need to be prepared to cover, either through insurance, assets, or a combination of both. Next, inventory your assets with an eye for repositioning. In my experience, most retirees have a portion of their portfolio in low-yield accounts. Think money market funds, CDs, or bonds earning less than 2% annually. Identify accounts that are not critical for daily living expenses or emergency reserves. For example, if you have $500,000 in total savings and $100,000 is sitting in a CD earning 1.8%, that $100,000 could be repositioned into a hybrid long-term care policy. The key is to use lazy money, funds that aren't working hard for you, to create leverage. Many asset-based policies can turn a single $100,000 premium into $300,000 to $400,000 in long-term care benefits, depending on your age and health. Let me repeat that. With one strategic move, you could triple or even quadruple your protection. The third step is to review your insurance and estate planning documents. This is where many retirees overlook critical details. Make sure your beneficiary designations are up to date and that your power of attorney and healthcare directives reflect your current wishes. If you're considering a hybrid policy, check if your existing life insurance or annuity contracts offer a long-term care rider or conversion option. In some cases, you can exchange an old policy using what's called a 1035 exchange into a new hybrid solution without triggering taxes. This is a powerful, tax-efficient way to upgrade your protection. For example, if you have a $75,000 cash value in an old life insurance policy, you may be able to transfer that value into a new hybrid policy, instantly securing $200,000 or more in long-term care benefits, often with no out-of-pocket cost and no new taxes due. The fourth actionable step is to get pre-qualified for coverage. Don't worry, this process is usually much less invasive than traditional long-term care insurance. Most asset-based policies require only a phone interview and a review of your medical records, rather than a full physical exam. The underwriting process typically takes 2 to 4 weeks from start to finish. During this time, you'll work with your advisor to select the policy features that fit your needs, such as inflation protection, shared care for couples, and return of premium options. If you're in your early to mid-60s, you're in the sweet spot for qualifying and locking in lower rates, but even retirees in their 70s can often secure meaningful coverage. The sooner you start, the more choices you'll have, and the more affordable your options will be. Once you're approved, the fifth and final step is to fund and activate your policy. This is where the rubber meets the road. You'll transfer the selected amount, let's say $100,000 or $150,000, from your identified account directly to the insurance company. In exchange, your policy is immediately active and you'll receive a contract outlining your guaranteed benefits. Most policies provide a detailed benefit schedule showing exactly how much coverage you have per month and per year and for how long. For example, a $100,000 single premium policy for a healthy 65-year-old might provide $5,000 per month in long-term care benefits for up to 6 years, with a built-in death benefit for your heirs if you never use the care. Your advisor should walk you through every detail, ensuring you understand how to access your benefits, file a claim, and coordinate with Medicare and other coverage. Let's pause here and recap what we've covered so far. First, you start with a realistic assessment of your long-term care risk and the potential financial impact. Second, you identify and reposition underperforming assets to maximize your leverage. Third, you review and update your insurance and estate planning documents, taking advantage of tax-efficient transfers when possible. Fourth, you get pre-qualified for coverage through a streamlined underwriting process. And fifth, you fund and activate your policy, locking in guaranteed protection for yourself and your loved ones. Now, I know you may have some concerns about taking these steps. For example, you might worry about tying up your money or about whether you'll qualify based on your health. You may be unsure about the tax implications or about how this fits with your overall retirement income plan. These are all valid questions, and they're exactly why I recommend working closely with an experienced, credentialed advisor, someone who understands the unique needs of affluent retirees and can tailor a solution to your goals. In my decades of experience, I've seen that the retirees who succeed with this process are the ones who start early, ask smart questions, and insist on clarity every step of the way. They don't rush, but they don't delay unnecessarily either. Every month you wait, your options narrow, and your costs may rise. The window for securing the best protection is often between ages 60 and 70. But I've helped clients in their late 70s and even early 80s find meaningful solutions. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any decisions. No strategy can guarantee specific returns or outcomes, but these steps have helped thousands of retirees protect their savings and their families from the high cost of long-term care. But before you take action, you need to avoid these critical mistakes that have cost retirees tens of thousands, even hundreds of thousands, of dollars. In the next section, I'll reveal the most expensive pitfalls I've seen, the warning signs to watch for, and how you can sidestep the traps that catch so many well-intentioned seniors off guard. Stay tuned, because what you learn next could be the difference between a secure retirement and a costly financial setback. Part 4. Common Mistakes and Pitfalls. Costly Errors that Undermine Long-Term Care Protection. Let's take a moment to pause and reflect on what we've covered so far. You now know the staggering costs associated with long-term care, the proven asset-based strategies that the most successful retirees use, and the step-by-step process to secure your own protection. But here's a crucial truth from my 30-plus years of guiding affluent retirees. Even the best-laid plans can unravel if you fall into one of the common traps that catch so many seniors by surprise. I've seen these mistakes cost families tens of thousands, sometimes hundreds of thousands of dollars, not to mention the stress and heartbreak that can follow. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation. No strategy can guarantee specific returns or outcomes, but learning from others' experiences is one of the safest ways to protect your wealth and your legacy. Let's talk candidly about the most expensive mistakes I've witnessed, the real financial costs, and the warning signs you need to watch for, so you can sidestep these pitfalls and keep your retirement plan on track. The first and perhaps most damaging mistake is waiting too long to act. I cannot emphasize this enough. Timing is everything when it comes to long-term care planning. Every year you delay, your options shrink, and the costs climb. I've seen retirees in their late 60s who could have secured $400,000 in coverage for a single $100,000 premium, wait until they're in their mid-70s, only to find that same $100,000 now buys less than $200,000 in coverage. Or worse, that their health has changed and they no longer qualify at all. The window for securing the best coverage is typically between ages 60 and 70. If you wait until health issues arise, such as a diagnosis of diabetes, heart disease, or even a recent hospitalization, many policies will be off the table, or the cost will skyrocket. I've seen families forced to pay out of pocket, draining $120,000 to $150,000 per year for care that could have been largely covered with earlier planning. If you find yourself thinking, "I'll get to this next year," consider this a gentle warning. Procrastination is the most expensive mistake you can make. The second costly pitfall is relying solely on traditional long-term care insurance without understanding the risks. In the past, traditional policies were the gold standard, but in recent years, many insurers have raised premiums dramatically, sometimes doubling or even tripling rates over a decade. I've seen retirees who budgeted $3,000 a year for premiums suddenly face bills of $7,000 or more. Worse, some companies have exited the market altogether, leaving policyholders scrambling for alternatives. If you have a traditional policy, review it carefully. Are the benefits keeping pace with rising care costs? Is there inflation protection built in? Do you know what would happen if you missed a payment? The warning sign here is any letter from your insurer about a premium increase or policy change. Don't ignore these notices. Review them with your advisor immediately. I've worked with families who lost $50,000 or more in benefits simply because they didn't respond to a policy lapse notice in time. The third major mistake is failing to coordinate long-term care planning with your overall estate and tax strategy. Many retirees believe that simply owning a policy is enough. But if your assets are not titled correctly, or if your beneficiary designations are outdated, you could unintentionally trigger taxes or disqualify yourself from future Medicaid benefits. For example, I've seen clients with large IRAs attempt to fund care costs directly from those accounts, only to face unexpected tax bills of $20,000 to $30,000 in a single year. Others have set up trusts or made gifts without understanding the 5-year Medicaid look-back rule, putting their family home at risk of a state recovery claim. The warning sign here is any major change in your family situation, such as a death, divorce, or new grandchild, or a significant move like selling your home or relocating to another state. These are times when your plan needs a thorough review by a qualified professional. A fourth pitfall, especially relevant in today's world, is falling for scams and unregulated solutions. That promise too much. Unfortunately, seniors are prime targets for financial predators. I've seen heartbreaking cases where retirees invested $25,000 to $100,000 in so-called guaranteed care programs or unlicensed insurance products, only to discover, when they needed help, that the company had vanished or the policy was worthless. The most successful retirees I work with always verify that their advisor is fully licensed, that the insurance company is highly rated, look for AM Best ratings of A or better, and that all paperwork is reviewed carefully. If you're ever pressured to sign on the spot, or if the offer sounds too good to be true, that's your red flag. Take your time, ask for written documentation, and run it by a trusted advisor before moving forward. Let's recap the warning signs and costs. Waiting too long can cut your coverage in half or leave you uninsurable, potentially costing your family hundreds of thousands in out-of-pocket care. Relying on outdated or misunderstood traditional policies can lead to sudden premium spikes or lost benefits, sometimes costing tens of thousands per year. Poor coordination with your estate and tax plan can trigger surprise taxes or even Medicaid disqualification, with penalties ranging from $20,000 to the loss of your family home. and falling for scams or unregulated products can wipe out decades of savings in an instant. In my experience, the retirees who avoid these pitfalls are those who act early, review their options regularly, and insist on working only with credentialed professionals. They keep copies of all their insurance and estate documents in a secure, easily accessible place. They update their plans after any major life event, and they never sign anything they don't fully understand. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making any decisions. No strategy can guarantee specific outcomes, but learning from these common mistakes can help you safeguard your retirement and your legacy. Once you avoid these traps, you can access advanced strategies that most people never learn, techniques for maximizing your benefits, minimizing your taxes, and ensuring your plan stays strong no matter what the future holds. That's just the beginning. Here's where it gets really powerful. In the next section, I'll share the advanced optimization strategies that wealthy retirees use to stretch every dollar, protect their families, and create a legacy that lasts for generations. Stay tuned, because what you're about to discover could transform your entire approach to retirement security. Part 5. Advanced Strategies and Optimization, Maximizing Long-Term Care Protection and Tax Efficiency. Now that you're aware of the most common mistakes and how to avoid them, it's time to elevate your long-term care strategy to the next level. Over my 30-plus years of working with affluent retirees, I've seen that those who truly thrive in retirement don't just settle for basic coverage. Instead, they optimize every aspect of their plan, using sophisticated techniques to maximize benefits, minimize taxes, and keep their legacy intact. The strategies I'm about to share are typically known only to industry insiders and the wealthiest retirees, but with the right guidance, you can put them to work for your own family. Remember, this is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor for your specific needs. No strategy can guarantee specific returns or outcomes, but these advanced approaches have helped thousands of retirees achieve greater security, flexibility, and peace of mind. Let's begin with a technique that's become increasingly popular among high-net-worth retirees. Leveraging IRA or 401k assets through a tax-efficient transfer to fund long-term care. Many retirees have a significant portion of their wealth tied up in tax-deferred retirement accounts. If you simply withdraw $100,000 from your IRA to pay for care, you'll face ordinary income tax on the entire amount, potentially owing $22,000 to $37,000 in federal and state taxes, depending on your bracket. But there's a smarter way. Some insurance companies now offer specialized, qualified long-term care annuities that allow you to transfer IRA or 401k funds directly into a hybrid policy using a tax-free rollover. The money grows tax-deferred, and when you need care, the payouts are treated as long-term care benefits, not taxable income. For example, I recently worked with a couple who rolled $150,000 from an old 401k into a qualified long-term care annuity. They instantly secured over $350,000 in care benefits without triggering a large tax bill. This approach can be a game-changer for retirees who want to put their retirement accounts to work while avoiding unnecessary taxes. Another advanced strategy is using a second-to-die or joint hybrid policy for couples. Many retirees don't realize that most long-term care events affect both spouses, often within a few years of each other. Rather than purchasing two separate policies, you may be able to secure a single joint policy that covers both spouses, and in many cases for less than the cost of two individual plans. These policies allow you to pool benefits, so if one spouse needs care for an extended period, the other still has access to remaining benefits. For example, a $200,000 joint policy for a healthy couple in their mid-60s might provide up to $600,000 in total long-term care benefits, with built-in death benefits if neither spouse uses the care. This approach not only provides greater flexibility, but can also simplify claims and reduce paperwork during an already stressful time. In my experience, the most successful retirees coordinate their planning as a couple, ensuring both partners are protected and that assets are preserved for future generations. A third optimization technique, and one of the most overlooked, is integrating your long-term care plan with your overall tax and estate strategy. This means looking beyond just the insurance policy and coordinating with your financial advisor, CPA, and estate attorney. For example, if you fund a hybrid policy with appreciated securities from a brokerage account, you may be able to use charitable giving strategies or donor-advised funds to offset capital gains taxes. Or, if you're concerned about estate taxes, you might structure your policy ownership through an irrevocable trust, removing the death benefit from your taxable estate and protecting it from potential creditors. I've seen retirees save $40,000 to $100,000 in taxes over the course of their retirement by carefully aligning their long-term care funding with their broader financial goals. The warning sign here is any major change in your tax situation, such as the sale of a business, a large inheritance, or significant investment gains. These are opportunities to revisit your plan and ensure every dollar is working as hard as possible for you. Let's pause and recap what we've covered so far. First, you can use tax-advantaged rollovers from IRAs or 401ks to fund long-term care without triggering large tax bills, potentially saving you tens of thousands of dollars. Second, joint or second-to-die hybrid policies can maximize benefits for couples, providing up to $600,000 or more in coverage for a single premium and ensuring both spouses are protected. Third, integrating your long-term care strategy with your tax and estate planning can unlock even greater savings and protect your legacy for the next generation. Of course, these advanced strategies come with their own complexities. It's critical to work with a team of qualified professionals, your financial advisor, CPA, and estate attorney, who understand how to coordinate these moving parts. The most successful retirees I work with schedule annual reviews to make sure their plan is up to date, their beneficiaries are correct, and their policies are still aligned with their goals. They also keep detailed records of all policy documents, tax filings, and estate plans, so their families can act quickly and confidently if care is ever needed. I want to emphasize again, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor and tax professional before making any decisions. No strategy can guarantee specific returns or outcomes, but these advanced techniques have a proven track record of helping retirees maximize benefits and minimize taxes. The key to success with these advanced strategies is getting your timing exactly right. Many of these options are only available at certain ages or before certain health events occur. For example, the IRS rules for qualified long-term care annuities are subject to change, and some insurance companies limit joint policies to couples under age 75. Every month you wait, your choices may narrow, and your costs may increase. The sooner you act, the more options you'll have, and the more you can save in the long run. So far, we've covered the advanced techniques that can help you optimize your long-term care protection, coordinate your tax and estate planning, and ensure both you and your spouse are covered. But even with the best plan in place, the implementation process can be complex, with important deadlines and steps to follow. Timing is crucial. Here's exactly when and how to take action, and what to expect over the next 30, 60, and 90 days as you put your plan into motion. Even if you follow this perfectly, you might encounter these common roadblocks. And that's what we'll tackle next. Stay with me, because understanding the implementation timeline can make all the difference between a smooth transition and costly delays. Part 6, Implementation Timeline and Sequence, your 30, 60, 90-day roadmap to long-term care security. Let's take a moment to appreciate how far you've come. You've learned the true risks and costs of long-term care, explored proven and advanced strategies for protecting your wealth, and discovered how to avoid the most expensive mistakes. Now it's time to move from planning to action. In my 30-plus years of helping retirees secure their financial future, I've seen that the difference between a good plan and real, lasting protection is all about timely, organized execution. When you have a clear, step-by-step timeline, you avoid costly delays, last-minute stress, and missed opportunities. Remember, this is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor for your specific needs. No strategy can guarantee specific outcomes, but following a proven implementation sequence can dramatically increase your odds of success and peace of mind. So let's walk through the ideal 90-day timeline for putting your long-term care protection in place, whether you're starting from scratch or optimizing an existing plan. This approach is built on decades of experience and is designed specifically for affluent retirees who value security, clarity, and control. First 30 days, assessment and preparation. The first month is all about gathering information, setting priorities, and building your team. Start by scheduling a comprehensive review with your financial advisor, ideally someone with deep experience in retirement and long-term care planning. If you don't have a trusted advisor yet, use this time to interview candidates, checking for credentials like CFP or CHFC, and for a track record of working with retirees in your income bracket. During this initial phase, collect all relevant documents, statements for your IRAs, 401ks, brokerage accounts, CDs, and insurance policies. Make a list of your current assets, income streams, and any existing long-term care coverage. Don't forget to include your Social Security benefit statement and recent tax returns, as these may influence your strategy. If you're married, gather your spouse's information as well. Next, complete a personal and family health assessment. Review your medical history, your spouse's, and your family's, especially any history of chronic illnesses or cognitive decline. This will help your advisor recommend the right type of coverage and determine if you're likely to qualify for preferred rates. By the end of the first 30 days, you should have a clear picture of your risk, your resources, and your goals. Set a deadline for this step, mark your calendar for 30 days from today, and hold yourself accountable. The sooner you finish this phase, the sooner you can move forward with confidence. Days 31 to 60. Solution design and application. With your information in hand, you and your advisor will spend the next 30 days designing your long-term care solution. This is where you'll compare options, hybrid policies, joint coverage, qualified annuities, or integrated estate planning, and run the numbers for each scenario. Ask your advisor to provide written proposals with specific dollar amounts, benefit periods, inflation protection options, and projected tax impacts. During this phase, schedule a meeting with your CPA or tax advisor to review the proposed funding strategies. If you're considering moving money from an IRA or 401k, confirm the tax implications and timeline for rollovers or 1035 exchanges. For couples, discuss whether a joint policy or two individual policies makes more sense based on your health and financial goals. Once you've chosen your solution, begin the application process. Most companies require a health interview, which can often be done by phone. Be prepared to answer questions about your medical history, medications, and daily activities. Some policies may request access to your medical records, so sign any necessary authorizations promptly to avoid delays. During this 30-day window, your advisor should also help you review and update your estate planning documents, especially your powers of attorney and healthcare directives. Make sure your beneficiary designations are current and that your family knows where to find all key documents. By day 60, your application should be submitted, your funding strategy should be finalized, and your estate plan should be up to date. Set a target date for this milestone, 60 days from your start date, and check in weekly with your advisor to ensure you're on track. Days 61 to 90. Approval, funding, and activation. The final 30 days are focused on securing approvals, transferring funds, and activating your coverage. Insurance companies typically complete underwriting within 2 to 4 weeks, but occasionally they may request additional information from your doctor. Respond to any requests immediately. Every day counts, especially if you're trying to lock in a specific rate or benefit. Once approved, you'll receive a policy illustration and contract. Review these documents carefully with your advisor, confirming that the benefit amounts, inflation riders, and death benefits match your expectations. Double-check the funding instructions, whether you're transferring $100,000 from a CD, rolling over $150,000 from a 401k, or using a 1035 exchange from an old life insurance policy. Confirm the tax treatment with your CPA before moving any funds. When your premium is received, your policy becomes active, often within 24 to 48 hours. At this point, you'll receive a policy delivery packet with instructions on how to file a claim, access benefits, and contact your carrier. Store these documents in a secure, easily accessible place and share copies with your spouse and any adult children involved in your planning. Before the end of the 90-day period, schedule a final review meeting with your advisor. Go over your entire plan one more time, making sure you understand every detail and that your family is informed. Mark your calendar for annual review dates. These check-ins will ensure your plan stays current as your needs and the law change. Let's recap your 90-day implementation timeline. In the first 30 days, you gather documents, assess your health and finances, and build your advisory team. In the next 30 days, you design your solution, review tax and estate impacts, and complete your application. In the final 30 days, you secure approvals, fund your policy, activate coverage, and communicate your plan to your family. This timeline is based on what I've seen work for thousands of retirees, and it's the same approach I use with my most successful clients. It's a conservative, safety-first method with a proven 40-plus year track record for protecting principal and ensuring peace of mind. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor and tax professional for your specific situation before making any decisions. No strategy can guarantee specific returns or outcomes, but following a disciplined timeline gives you the best possible chance at success. Even if you follow this perfectly, you might encounter these common roadblocks: delays in medical records, last-minute tax questions, or changes in your health status. In the next section, I'll show you how to troubleshoot the most common implementation challenges, provide solutions and workarounds, and answer the what-if scenarios that keep so many retirees up at night. Once you master this foundation, you're ready for the next level, and that's where your plan truly becomes bulletproof. Stay with me, because what's coming next can make all the difference in your long-term care security. Part 7, Troubleshooting and Problem Solving. Overcoming roadblocks on the path to long-term care security. Now that you have a clear 90-day roadmap for implementing your long-term care protection, let's address something I've seen time and again over my 30-plus years helping affluent retirees. Even the best plans can hit unexpected roadblocks. The difference between retirees who achieve lasting security and those who struggle is not whether challenges arise. It's how quickly and confidently you address them. In this section, I'll walk you through the most common implementation challenges, the solutions that have worked for thousands of my clients, and a few what-if scenarios that might be keeping you up at night. Remember, this is educational content, not personalized financial advice. Every situation is unique, so always consult with a qualified financial advisor for your specific needs. No strategy can guarantee specific outcomes, but learning how to troubleshoot and adapt can make all the difference for your retirement security. Let's start with one of the most frequent stumbling blocks: delays in underwriting or medical records. Many asset-based long-term care policies require a review of your medical history. Sometimes insurance companies request additional records from your doctors, which can take weeks or even longer if your physician's office is slow to respond. I've seen retirees become frustrated when a process they expected to take 30 days drags out to 60 or more. Here's the solution. At the very beginning of your application, proactively contact your primary care doctor's office and let them know to expect a records request. Ask if there's a preferred process for expediting paperwork. If you haven't had a recent physical, consider scheduling one, as up-to-date records can speed things along. And always follow up, either personally or through your advisor, every 7 to 10 days until the records are sent. The most successful retirees I work with stay politely persistent, which can shave weeks off the timeline. Another common issue is health changes during the application process. Imagine you're 45 days into your 90-day plan and suddenly you're diagnosed with a new health condition, or you have a minor accident that requires hospitalization. Many retirees worry this will automatically disqualify them. In my experience, it depends on the severity and timing. If your application is already in underwriting and the event is minor, insurers may still approve you, possibly with a small rate adjustment. If it's a major new diagnosis, your options could narrow, but not necessarily disappear. Here's what you do. Notify your advisor and the insurance company immediately. Full disclosure is essential. Trying to hide information can void your coverage later. Ask your advisor to shop your case to multiple carriers, as underwriting standards vary widely. I've seen clients with recent surgeries or controlled chronic conditions still secure coverage by working with an experienced agent who knows which companies are most flexible. The key is transparency and flexibility. A third challenge is unexpected tax or funding complications. Sometimes retirees discover late in the process that moving money from a particular account, like an IRA or appreciated stock, will create an unexpected tax bill. Or the bank or brokerage may have its own processing delays. To avoid surprises, always involve your CPA or tax advisor early in the process and confirm the exact tax implications of any rollover, 1035 exchange, or withdrawal before you sign paperwork. If a tax issue arises midstream, pause and consider alternatives. Could you fund the policy over several years to spread out the tax impact? Could you use after-tax dollars from a different account? In one recent case, a client planned to use $100,000 from an IRA, but realized the tax bill would push them into a higher bracket. Instead, we used $50,000 from cash savings and $50,000 from a brokerage account, minimizing the tax hit and still securing $350,000 in long-term care benefits. The lesson? There's almost always a workaround if you act early and communicate openly with your advisory team. Let's discuss a what-if scenario that causes anxiety for many retirees. What if I'm declined for coverage? This is a real concern, especially if you're applying in your late 70s or have significant health issues. If you're declined by one insurer, don't panic. First, ask for a copy of the underwriting report and review it with your advisor. Sometimes denials are based on outdated or incomplete information that can be corrected. Second, have your advisor shop your case to other carriers. Underwriting criteria differ, and another company may approve you. Third, consider alternative strategies. Some annuities and life insurance products offer chronic illness riders with less stringent health requirements. In some cases, you may be able to set aside a dedicated investment account, sometimes called a self-insurance fund, using conservative, principal-protected vehicles to cover future care needs. While not as efficient as a true long-term care policy, this approach can still provide a safety net. Here's another scenario I hear often. What if my family or power of attorney needs to access my policy? The most successful retirees I work with always prepare for this. Make sure your spouse, adult children, or power of attorney know where to find your policy documents, who your advisor is, and how to contact the insurance company. Many insurers offer care coordinators who can walk families through the claims process. Schedule a family meeting after your policy is issued. Review the basics, answer questions, and make sure everyone knows what to do if care is ever needed. This simple step can prevent confusion and delays during a stressful time. Let's pause and recap what we've covered so far. We've discussed how to speed up underwriting by communicating with your doctors, how to handle health changes during the process, how to solve unexpected tax and funding issues, what to do if you're declined for coverage, and how to prepare your family for future claims. These are the real-world challenges I've helped thousands of retirees overcome, and with the right approach you can do the same. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor, tax professional, and attorney for your specific needs before making any decisions. No strategy can guarantee specific outcomes, but being prepared to troubleshoot and adapt will put you ahead of the curve. Once you master this foundation, you're ready for the next level, where you can not only protect yourself from long-term care costs, but also optimize your benefits, scale your strategy, and make smart adjustments as your needs change. In the next section, I'll show you how to take your plan further, maximizing results, scaling your protection, and building in flexibility for the long term. What's coming next is the real secret to staying secure, confident, and in control, no matter what the future brings. Stay tuned because these next-level actions can truly elevate your retirement strategy. Part 8. Next-level actions and optimization, maximizing results, scaling your strategy, and long-term adjustments. You've come a long way on the journey to protecting your wealth from long-term care costs. By now, you understand the risks, have seen how the most affluent retirees build robust protection, and have learned how to troubleshoot common challenges. But here's what separates the truly successful from everyone else: next-level optimization. In my 30-plus years of guiding retirees, I've seen that those who thrive in every phase of retirement don't just set a plan and forget it. They continually refine, scale, and adapt their strategies as their lives and the financial landscape change. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation. No strategy can guarantee specific outcomes, but these advanced approaches have helped thousands of retirees maximize their results and maintain peace of mind for decades. Let's start with scaling your protection as your needs evolve. One of the most powerful yet underutilized approaches I've seen is the periodic review and layering of coverage. Most retirees set up a single policy and never revisit it. But the wealthiest, most proactive retirees schedule annual or biennial reviews, especially after major life events like a move, a health change, or the birth of a new grandchild. During these reviews, they look for ways to add supplemental coverage, increase benefit periods, or purchase inflation riders. For example, if you initially purchased a $200,000 hybrid policy at age 65, but your assets or care needs have grown by age 70, you can often add an additional $100,000 to $200,000 of coverage with a supplemental policy. This layering approach means you always have enough protection, even as costs rise or your health profile changes. The key is to stay flexible and proactive. Don't wait until you need care to realize your coverage is outdated. Another next-level technique is integrating long-term care planning with your broader retirement income and tax strategy. The most successful retirees I work with treat their long-term care policy as a dynamic part of their cash flow plan. For instance, you can coordinate policy withdrawals with Social Security claiming strategies, required minimum distributions, RMDs, and Roth IRA conversions. Suppose you receive $47,000 per year in Social Security and $30,000 from RMDs. By timing policy withdrawals and care benefits, you may be able to keep your taxable income below key Medicare premium thresholds, saving thousands of dollars in surcharges over time. Some retirees even ladder the funding of multiple hybrid policies, using after-tax dollars in their 60s, then tapping IRA assets in their 70s when RMDs begin. This sophisticated sequencing can help you optimize taxes and keep more of your wealth working for you and your family. Let's talk about legacy optimization and estate planning, an area where many retirees leave money on the table. Wealthy retirees often use irrevocable trusts to own their long-term care policies, removing the death benefit from their taxable estate and protecting it from creditors. In some cases, they combine this with charitable giving strategies, using policy death benefits to fund a donor-advised fund or family foundation. This not only protects assets during life, but also creates a lasting legacy that reflects your values. For example, I've worked with couples who used a $500,000 hybrid policy to provide $300,000 in care benefits during their lifetime, with the remaining $200,000 funding scholarships for future generations. The lesson here is that your long-term care strategy can and should work hand in hand with your estate and philanthropic goals. A critical next-level action is building in flexibility and contingency plans. Life is unpredictable, and your care needs may change suddenly. The most secure retirees maintain a Care Action File, a folder or digital vault containing all policy documents, contact information for advisors, care providers, and power of attorney instructions. They also establish clear communication protocols with family members, ensuring everyone knows how to access benefits and make decisions if needed. Some retirees even set up annual family meetings to review the care plan, update documents, and discuss any changes in wishes or resources. This ongoing engagement keeps your plan current and your family prepared, no matter what curveballs life throws your way. Let's not forget about my periodic optimization for tax efficiency. Tax laws change, and what worked 5 years ago may not be optimal today. The most successful retirees review their funding strategies every year, looking for opportunities to convert traditional IRAs to Roth accounts, harvest tax losses, or take advantage of new IRS rules on qualified long-term care annuities. For example, if Congress increases the standard deduction or changes the rules around medical expense deductions, you may be able to deduct a portion of your policy premiums, saving thousands of dollars annually. Staying informed and adjusting your strategy with your CPA or tax advisor is a hallmark of next-level planning. Another advanced optimization is leveraging policy return of premium or cash value features. Many modern hybrid policies offer the option to surrender the policy and recover most or all of your premium if your needs or goals change. This flexibility can be invaluable if you experience a major life event, need to rebalance your portfolio, or decide to reallocate assets. In my experience, retirees who select policies with strong liquidity features sleep better at night, knowing they retain control and access to their capital if circumstances shift. Let's recap the core next-level actions for maximizing your long-term care protection. Regularly review and layer your coverage, integrate your strategy with retirement income and tax planning. Use trusts and charitable strategies for legacy optimization. Maintain a flexible and accessible Care Action File. Stay current with tax law changes and select policies with strong liquidity features. These are the same techniques I've seen used by the most successful retirees, those who not only protect their own security, but also create a meaningful legacy for their families and communities. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor tax professional, and estate attorney for your specific needs before making any decisions. No strategy can guarantee specific outcomes, but next-level planning gives you the greatest possible control, confidence, and peace of mind. As we prepare to wrap up, remember, retirement security is not a one-time decision. It's an ongoing process of review, optimization, and adaptation. The sooner you build these habits, the more resilient your plan will be, no matter what changes in your health, family, or the law. And that brings us to our conclusion. You've learned the insider strategies, practical steps, and advanced techniques that wealthy retirees use to protect themselves and their loved ones from the rising costs of long-term care. But how do you put all this together into a single, actionable plan that's tailored to your life? In the final wrap-up, I'll show you how to synthesize everything you've learned, take decisive action, and ensure your retirement years are defined by security, dignity, and legacy. Don't miss this last essential step, because it's where all the pieces come together for your peace of mind. Over the past hour, we've covered a tremendous amount of ground together, delving into the realities of long-term care costs, the proven strategies that the wealthiest retirees use, and the step-by-step process for protecting your hard-earned assets. Let's briefly recap the 8 key insights we explored. First, we uncovered the staggering probability and financial magnitude of long-term care expenses and why Medicare and Medicaid offer little protection for affluent retirees. Second, we introduced asset-based and hybrid long-term care solutions, which offer both care benefits and legacy protection. Third, we walked through a practical implementation timeline, breaking the process into clear 30, 60, 90-day steps. Fourth, we addressed the common mistakes that can cost retirees tens or hundreds of thousands of dollars and how to avoid them. Fifth, we revealed advanced optimization strategies like tax-efficient IRA rollovers, joint policies, and trust integration to maximize benefits and minimize taxes. Sixth, we discussed troubleshooting real-world challenges from underwriting delays to health changes and funding surprises. Seventh, we explored next-level actions, scaling your protection, layering coverage, and integrating your plan with your broader financial, tax, and estate strategies. And finally, we emphasized the importance of ongoing reviews and family communication, ensuring your plan remains strong as your needs evolve. The knowledge you've gained could save you and your family hundreds of thousands of dollars, years of stress, and give you confidence that your retirement is truly secure. This represents decades of experience distilled into practical guidance, financial education designed to empower, not just entertain. Now that you understand each piece, here's how they work together. The wealthy retirees I advise didn't get there by accident. They follow proven systems that combine asset-based solutions, tax efficiency, and regular reviews. When you implement these strategies as a coordinated plan, the benefits compound. Repositioning $100,000 from low-yield savings into a hybrid policy can secure $300,000 to $400,000 in long-term care coverage, while also preserving a death benefit for your heirs. If you and your spouse both need care, joint policies can pool benefits and stretch your dollars even further. By integrating your long-term care solution with your retirement income planning and estate strategy, you create a resilient financial shield, one that adapts as your needs and the law change. Let me emphasize this important point. This is why wealthy retirees often outperform those with even more starting capital, because they optimize, coordinate, and act early. After helping retirees navigate multiple market cycles, I can tell you, what separates financially secure retirees from those who struggle is usually knowledge and implementation, not just luck or investment returns. So, what are your immediate action steps? Here's a clear 4-week plan to move from knowledge to results. Week 1. Assessment phase. Start by gathering 3 essential documents: your most recent retirement account statements, your existing insurance policies, and your last 2 years of tax returns. Calculate your current exposure by multiplying the average annual nursing home cost in your area, currently about $108,000, by 3 years per person. Identify your biggest opportunity area. Is it repositioning low-yield assets, updating outdated insurance, or filling a coverage gap? Week 2, Planning Phase. Create your personalized timeline based on your age, health, and retirement goals. Research the specific hybrid and asset-based options we discussed, focusing on policies with strong financial ratings and flexible features. Document your current long-term care plan, if any, and compare it to the optimized strategies you've learned here. Note the differences and potential improvements. Week 3, Professional Consultation. Schedule a meeting with a qualified financial advisor who specializes in retirement and long-term care planning. Bring these specific questions. What are my best options for asset-based long-term care coverage? How can I fund a policy tax efficiently? Do you coordinate with my CPA and estate attorney? Verify that your advisor understands advanced strategies like 1,035 exchanges, IRA rollovers, and trust integration. Week 4, Implementation begins. Start with the lowest risk, highest impact change, such as repositioning cash or CDs into a hybrid policy. Set up the necessary accounts or policy applications. Begin tracking your progress with a simple checklist. Documents gathered, options reviewed, applications submitted, and beneficiaries updated. By the end of 30 days, you should have a concrete action plan underway. Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, adjusting as they go. Don't let perfectionism prevent you from starting with small improvements. Even incremental steps can compound into major benefits over time. Let me emphasize, these aren't get-rich-quick schemes. They're conservative, proven, long-term strategies designed to protect your independence, your dignity, and your legacy. This is educational content designed to inform your decision-making. Every individual's financial situation is unique, so always consult with qualified financial, tax, and legal professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and tax laws may change. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and your needs will shift. Continue your education by staying informed about retirement planning developments, and consider joining discussions or groups where retirees share their experiences and lessons learned. Share your success stories and learn from others who are implementing these strategies. Protecting your family's financial future is a team effort, and your wisdom can help others on the same path. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps others like you find this vital information. Share your biggest takeaway in the comments. Which strategy will you implement first, or what surprised you most about the approaches we discussed? Subscribe for more in-depth retirement planning guidance that could save you thousands or even hundreds of thousands over your retirement years. Most importantly, take action on what you've learned. Your future self, your family, and your legacy will thank you. You'll know you're on the right track when your financial stress decreases, your questions have clear answers, and you feel confident in your long-term care plan. The cost of inaction often exceeds the cost of making imperfect but informed decisions. The sooner you implement these strategies, the more time they have to work in your favor. You now possess knowledge that many retirees never acquire. Use it to your advantage. In my decades of helping retirees optimize their finances, I've seen these principles work across every market cycle and family situation. Imagine the peace of mind that comes from knowing you've protected your nest egg, your independence, and your family's future. Sleep better tonight knowing you have a clear, actionable plan, one built not on guesswork, but on proven strategies and professional guidance. Thank you for investing your time and trust in this journey. Your experience and wisdom, combined with these strategies, create a powerful advantage. The next step is yours. Don't let it slip by.